On July 4th, Congress passed what's being called the One Big Beautiful Bill. As we all know, there's a major piece of tax legislation that will impact the tax codes, but there are a lot of provisions of this bill that apply to certain individuals and a lot of provisions that apply specifically to the clients that we serve, which are retirees or pre-retirees in the academic and university space. There are four major aspects of the bill that I'm going to go over today that I think are relevant. Number one, the standard deduction has increased for all taxpayers. So if you're an individual taxpayer at the age of 65 and older and you're single, your standard deduction went from $17,000 to $17,750. For married individuals or individuals filing taxes jointly, the standard deduction increased from $33,200 to $34,700. The other big aspect of the bill is the Enhanced Senior Deduction. This is for any individual at the age of 65 or older. They are eligible to receive an additional $6,000 deduction. However, to qualify, your total income, if you are a single taxpayer, has to be under $75,000. If you're over $75,000, there's a phased reduction of that benefit. And for joint taxpayers, the total income has to be $150,000. And again, there is a phased reduction if your income is above $150,000. So what do you do, or how do you know if you're eligible for this deduction where your income is? Well, one of the things that we do here at Emeritus is we provide tax projections for our clients. We could use your 2024 tax returns and help generate a tax projection for your 2025 returns to see where your total income might fall into and how much of that enhanced senior deduction you might be eligible for. So what if you are over that income threshold and you want to really try to take advantage of it? Well, if you're still working, one of the easiest aspects that we can look at is making sure you're maximizing your 403B or your 457B deferred compensation plan. By increasing your contributions into your employer-sponsored retirement plan, that will help reduce your taxable income, allowing your income to fall lower and maybe being eligible to maximize that full deduction. Or if you're no longer working and you're subject to mandatory distributions from your retirement accounts and you're charitably inclined, one of the easier ways to reduce your taxable income is to donate aspects of your mandatory distribution to charity as a tax-free gift. That has the benefit of obviously you supporting the charitable causes that you're passionate about, but the other aspect is that will also reduce your taxable income, helping you qualify more for that enhanced senior tax deduction. So that is something that you should consider or have review as part of your tax planning process. The third aspect of the bill that are relevant to the individuals that we serve is that the state and local income tax deduction, which was at $10,000, is now increased to $40,000. So the state and local income tax, as you know, was capped at $10,000. So if you had property taxes of $20,000, $30,000, the most you can deduct is $10,000. Now, under this provision, you can deduct up to $40,000, assuming that your household income is under $500,000. Again, that's another aspect that we want to review your tax documents to see how we can reduce your income under that $500,000, so that way you can get the full $40,000 if you're eligible for that deduction. The fourth or final item, which is just more of a planning aspect, is that these tax cuts are made permanent. So the marginal tax rates were supposed to increase in the future. Now these cuts are permanent. This will open up ideas for more Roth conversions for those who have continued to do Roth conversions over the last several years, and brings more certainty to the planning now that we know that tax laws are not going to be changing. But overall, one of the biggest aspects that we provide for our clients is tax projection. And we like to provide with our clients a side-by-side projection to show you what the actual tax benefits you're receiving under this current law. So we will take your previous returns, use that to generate a projection of your 2025 tax returns, comparing the old law versus new law, so you could see what tax savings you're implementing and also what you might be missing out by not taking on certain strategies.